Any question from our previous discussion? Maybe during your reading, you saw something that you want me to address it, so kindly let me know if there are things that maybe you were going through that you want me to help you discuss. Then we look at it before we continue. Okay, so if there is no class, can you help me with the type of audit opinion we discussed last time? The audit opinion we discussed last time, if you can help me recall what we learned. Hello? I'm saying last week or just Friday, I just want to help me tell me some of the audit opinion we discussed. That our brother Andrew summarized it for us before we close from the class. No one is willing? Or
Sir,
we are all not? Yes, sir.
good evening.
Good evening, sir.
I hope you are fine.
Please, I'm doing well. And yourself?
By the grace of God, I'm fine.
Right. Thank you for asking. Right.
Um, please, what I remember that we learned about audit opinion is that it could be qualified as it could be qualified or unqualified.
Okay. Good. It will be qualified or unqualified. Okay. Is there another thing you want to add?
Yes,
Oh, okay.
the qualified opinion must be expressed by the auditor when certain situations are present. And this, what we learned was that there is a material misstatement in the financial statement, but not pervasive.
Okay.
Or the auditor cannot obtain sufficient appropriate audit evidence. The effect
Okay.
is material but not pervasive. That is what I remember we discussed.
Okay. That's fine. Thank you. Who else again want to say something?
So
Yes, Madam Gifty.
we also we also discussed the disclaimer of opinions,
Mm-hmm.
and we said that it's obtained sufficient appropriate audit evidence to provide a basis for an audit opinion.
Okay. Okay.
Uh,
Yes. Yes.
another one that we also discussed was an adverse opinion,
Mm-hmm.
where it refers to when the auditor states that probably the financial statement does not present a true and a fair view.
Okay. Okay. So thank you for your input. So last time, yes, we looked at type of opinion. We have type of opinion. We have the modified opinion and unmodified opinion. So unmodified opinion actually occurs when auditors do not find any issue with the financial statement, as in there's nothing like material misstatement, and there's also nothing like a lack of sufficient appropriate audit evidence. So if they don't find all this there, then they can say that, yes, our opinion is what? Unmodified. Unmodified. So they will write on a modified report saying that their opinion, everything is fine. There's no material misstatement. There is also appropriate, or there's sufficient appropriate audit evidence. We also said that if there is material misstatement or there is lack of sufficient appropriate appropriate audit evidence, then would inform then will inform the auditor his opinion, and that he will give a qualified opinion. So in that case, that report will be called a modified report. But when there are no issue of material misstatement, when there is no lack of sufficient appropriate evidence, then he will give a, what we call an unqualified opinion, which will be a unmodified report. So which will be a modified report. But then, if there is material misstatement, or if there is what we call there's lack of sufficient appropriate evidence, then there will be what we call a modified report, which will bring about a qualified opinion. Now, with this qualified opinion, the qualified opinion is happening if it is pervasive, then you will give an adverse opinion. That is, if there's material misstatement and it is pervasive, meaning it is serious, you will give what we call adverse opinion. So please get this right. If the material misstatement is pervasive, meaning it is serious, the auditor opinion will be adverse opinion. Though it is a qualified opinion, but then it's an adverse one. Note that, because a qualified opinion occurs when there's material mistake, or when there's lack of sufficient appropriate audit evidence. That brings about a qualified opinion. Now, when it becomes pervasive, that is where the adverse come in, and the adverse will only come in if and only if there is material misstatement and it's a serious one. That is when you will give an adverse opinion. But then, if there is lack of sufficient appropriate evidence and it is not serious, the auditor will not only but if it is serious or it is pervasive, then you will give what we call a disclaimer.
Yes, sir.
Yes, please.
Your line
My
is not
lines
loaded.
keep on going. Okay, so please 1 minute. So let me join it. All right. So please, I'll get back to you 1 minute. So please, can you hear me now?
Yes, sir.
Yes, sir.
Right. So I was saying that if the auditor, if the auditor gives an adverse opinion, it's because there is material misstatement and it is pervasive. But if there is material misstatement and it is not pervasive, then you only give a qualified opinion. That's what happened. Then the next one is that if there is lack of sufficient appropriate evidence and it is serious, the auditor will give a disclaimer. But if it is not serious, then he will still give a qualified opinion. I hope with these ones you understand, because auditing, after doing all the investigation, you need to write the audit report. And the audit report can be a modified one or unmodified one. Unmodified one means there is unmodified opinion or unqualified opinion. But if it is a modified report, then it's a qualified opinion. And that opinion, we need to ask ourselves, is it pervasive? So is the issue pervasive or is not pervasive? If the issue is pervasive, then it is either they are having a disclaimer will bring about just a qualified opinion. That's what happened. So in my search, at least I got some information here and I'm reading it. We draw attention to, maybe this is just an example. We draw an attention to note 27 to the financial statement, which describes the effect of a fire in the company's warehouse. Our opinion is not modified in respect of this matter. So with this issue, is this one you are seeing? Because they said our opinion is not modified in this matter, it means they have given unmodified opinion. But look at the next sentence. We have audited, in our opinion, except for the possible effect of the matter described in the basis of qualified opinion section of our report. The financial statement presents fairly in all material respects. Because they said, except for, the word except for. Because he's saying except for there, it means they are giving what we call a qualified opinion. And this except for means the issue is not pervasive. That's the reason why they are giving a qualified opinion. That's why they are giving a qualified opinion. So now you're looking at it, how they write the information. So if we ask you to write something concerning an opinion, and it's a qualified one, which is not pervasive, we need to see the word except for. That's what you must note. Look at this one too. We were engaged to audit. We do not express an opinion on the accompanying financial statement because of the significance of the matter described in the basis for disclaimer of opinion section of our report. We have not been able to obtain sufficient appropriate audit evidence to provide a basis for audit opinion on this financial matter. So you look at the word, they said we were not able to obtain sufficient appropriate audit evidence. So because they were not able to obtain that, and then this able mean because they are not able to obtain that, it is possible that it is pervasive. That's the reason why if we had seen except for, so maybe they can say we were able to obtain sufficient evidence, except for this. If they have mentioned except for this, then it means it would have been a qualified opinion. By this one, they are being frank and saying that we were not able to obtain sufficient audit evidence. It means this is what we call a disclaimer opinion. And look at their basis of opinion. We were not appointed as auditors until a particular date, and thus did not observe the physical inventory count at the beginning and at the end of the year. In addition, introduction of a new computerized system in a particular date resulted in numerous errors in account receivables. So it's like they are trying to give their basis, the reason why they are giving that opinion. That is a disclaimer opinion. So you note, you have seen the differences. Now let's look at the last one. Look at this. Okay, this is the same a qualified opinion, and this is the basis of it. So this is how except for this is also a qualified opinion, except for. But look at that verse. In our opinion, because of the significant matter described in the basis for adverse section of our report, accompanying financial statement do not present fairly. So what it means is that it means there is material misstatement, and this material misstatement is pervasive. That's the reason why they are giving this opinion. Then let's look at their basis. The company's financial statement, a company's financing arrangement expired. And it is considering filing for bankruptcy. A material uncertainty exists. So the financial statement do not adequately disclose this fact. It means there is material misstatement. That's the reason why they are giving adverse opinion. So if it is not pervasive, then it is just a qualified opinion. But if it is pervasive or it is serious, then they will either give adverse or disclaimer. Please, I hope with this explanation, we are all okay that if I'm to ask you again, you'll be able to tell me the meaning of this opinion I have just described or discussed with you.
Sir.
Yes, sir.
Please, I have a question.
Please, you can ask.
I want to find out the difference between the adverse and the disclaimer. Whether it's, per my understanding,
Mhm.
it looks as if there is a similarity between the two,
Which one and which one?
the adverse and then the disclaimer. Because, as you rightly indicated, that with the adverse, when there is a misstatement, um, when misstatements are both material and pervasive, and then with the disclaimer too also has that element that
Of what? Element of what? Disclaimer had an element of what?
lack of information, and as a result, it also there's a possible effect of material and pervasive in it. That's
Right,
why I wanted to
right.
find out the distinction between the two.
Okay. So the distinction between the two of them, the adverse and disclaimer, is that adverse is paying attention to there is material misstatement. Material misstatement means there's an item they're supposed to state it well, but they didn't state it right. So information they're supposed to disclose well, they didn't disclose it well. That's what we say there is material misstatement. When there's lack of evidence or appropriate evidence, it means that as a account or maybe accounts people, most often when you go and buy something, they will ask for receipt, invoice. They want to verify the evidence of the transaction which has taken place. So the audit requires for what? A source document as a way of verifying. So now, if the auditor comes to audit and the auditor is requesting that go and bring this receipt and you are not able to produce it, you have recorded it though, you have recorded it in your books. You didn't state it wrongly. If you have stated the figure wrongly, then we have said it is misstatement. If there was an evidence and you didn't state the figure very well, it means there's misstatement. But this one, we have stated the figure, but there is no evidence attached to that figure you are saying. Or someone, you sold goods to someone, and the person said he has paid. So you recorded, but then there is no evidence that the transaction has been sent into the bank account. When they are requesting for it, you are not able to produce it. In that case, because the source document or the evidence is missing, though you have stated that it is there, but then you are also telling us, go and bring it, say you cannot bring it. In that case, we are not able to obtain the evidence that we are supposed to obtain for us to give our opinion. So one is talking about you going for an evidence and that evidence was not given to you. And one is also saying that you have stated something, but what you have stated is wrong. So if what you have stated is wrong, or there's an issue in what you have stated, and it is very serious that it is affecting all the financial statements, then we are saying that that one is an adverse, the auditor will give an adverse opinion on that. But if what you have stated to us, as we are looking for, everything was right, but the only thing is that we need an evidence to prove the transaction, but you are not willing to give to us, then the auditor will say that, yes, indeed, you have stated this and that, but then we are requesting for an evidence to investigate into the issue, whether indeed that transaction has taken place, but you're not able to provide for it, or you're not even willing to give it to us. In that case, we are giving a disclaimer. So if the issue is serious, that is where they give a disclaimer. But if it is not serious, then they will just give a qualified opinion. So the one is looking at evidence and one is looking at misstatement. That is the difference between the two. But all must be serious before you can give one. All must be pervasive before you can give those opinion. Please, are you okay with my explanation?
Yes, sir.
Right. Any other question from anyone?
Sir, do we
Okay.
suggest to say that because of the seriousness of the matter
Yes.
being pervasive, the auditor does not express any opinion at all, as far as the disclaimer is concerned,
So, because
right?
of the seriousness of the matter, he will express his opinion, but it will be either an adverse or disclaimer. The opinion he will almost express. Even if he said, I can't express my opinion, he has still given the reason why he's saying he will not express his opinion on it. Please, you get it. So if he said he will not express his opinion on it, it means it's like he wants to give a disclaimer saying I can't do that because of this. So that's why you have the basis of that opinion, saying that why do you think you can't express your opinion on that? You need to tell us the reason why we are saying. So if you look at this statement, they said we have not been able to obtain sufficient evidence to provide a basis for audit opinion on this financial statement. So, yes, and they are giving their basis for not expressing their opinion, because auditor's opinion is to say that the financial statement is true and fair in all material respects. So if they are saying they are not able to give that, they should give the reason why they are not able to give that. And they are saying that They are saying they wanted to obtain sufficient evidence, and they were not giving that sufficient evidence. So because of that, they think that this sufficient evidence was a serious evidence that they needed to buttress their point or to say to express their opinion, but because they didn't get it, to them they want to give a disclaimer. But with the adverse one to but with adverse to what happens is that if they are saying that everything in material, everything that they give, the information they gave to us, the assertion that they made, there was material misstatement. So because of that, they want to give an adverse opinion because of the seriousness of the matter. Then they will give. So what happens is that if they give an adverse opinion, is because there is an issue with respect to what material misstatement, and it is serious. That's the reason why they are giving that. Please, are you okay?
So I'm grateful.
Right. Any other question from anyone? So now, if you are being asked to describe the opinions, you should be able to tell the story about all of them. And then, if you are being asked to write a report, you should be able to note that. So maybe our next meeting, maybe on Friday, to end the, and we'll be solving questions to know how to approach such things on all what you've done. You'll be solving questions on it on Friday. But today, we want to conclude on other matters that we have left. So that is what we have. Today, auditors also must look into related parties. Related parties. Related parties. Now, I believe that you have learned advanced accounting, and your teacher may have talked about consolidation. And in consolidation, he mentioned something we call related parties, or you've not heard of it before. Related parties.
Sir, no, sir.
You've not heard of it before. Okay,
Yes, sir.
okay, right. So when we talk about related parties, they are the close associates of the organizations. They are the close associates of the organizations. And the auditor must get to know all of them. So one or the other, they are like individuals or they are entities that they have relationship with the organization. It's either they have control over the organization or together with us as an organization. So maybe there's one organization together with us. We have maybe a joint control, or
Sir.
they may have a significant influence on us. They may have a strong influence on us, or maybe we may have a significant influence with them. In that
Sir,
case, yes, Gifty.
sir, sir, please, in our advance account, we're taught of the parent and the subsidiary. So I don't know whether those things are
Yes,
called
yes,
the
they are
related
all part of the related
parties.
parties transaction.
So I don't want to be ungrateful to my teacher. That's why.
Oh, is it Mr. McLean?
Yes, sir.
Yes, yes, okay, that's fine. Right. So they are individuals. They are entities that the organization have association with them or they have relationship with them. So they associate with them either by they having business transactions or maybe they may also engage themselves in some activities that one or the other it makes them related parties. So, for instance, you may have your company. then your uncle is also having a different company. And because your uncle is having a different company and you are into providing of food, you are part of the school feeding program. So you prepare food for the kids. And your uncle also have farms, poultry farms. And because you need eggs and you need chicken for the preparation of your food, you decided that because you know your uncle, you want to buy the chicken and then the eggs from your uncle, and then you use in the preparation of the food. So now, when the auditors come to audit the company, you should be able to tell them that yes, indeed, you tell them that all the business I am dealing with, this is my business. This person is a related party because one or the other, I have a personal relationship with the because it's my uncle who is providing the eggs for me. So then we now ask that at what price was your uncle giving you the eggs? Is it a reasonable price or it is a price that it is not equal to even the market price? So if it is equal to the market price, you need to disclose it for the auditor to understand that, okay, this transaction was a related party transaction because one or the other, your uncle is a company, have an association with your company or have a relationship with your company. So always the auditor must investigate to know all the related parties the business has and get to know the transactions and understand how the transaction took place to know whether the transaction was fairly done or it was not well done. That is what happened. So the auditor must understand the related party transaction because sometimes there can be a fraud or there can be fraudulent activity taken on between the related parties. So we need to understand. And then as well too, the auditor will be doing that to see whether the transactions that they have recorded was fairly presented. That's the reason why the auditor is requesting to understand the relationship between the related party transactions. So the auditor wants to know how it has been presented, how it has been accounted, and get to know whether if there was any fraudulent activity taking place. Remember, he is not there to detect fraud, but then if maybe a transaction uh, took place because of a fraud, then he needs to inform those charged with what governance. Now, when the auditor enters into the organization to audit the company, what he must do is that he must request for all the records that indicated in related parties or that may have indicated related parties. So, for instance, maybe your company or your business is still with the school feeding program. Then there are some people who supply with oil. There are some people who supply you with rice. Others who supply you with the chicken. Your uncle supply you with the chicken. So now the rice, is it from your mother company, that is your parent company, who is supplying with the rice, or is from another subsidiary who is supplying with the rice? We need to ask. Then we ask ourselves, in terms of the oil, who is supplying that? So the auditor asks all the questions and requests for all the documents that may indicate what related parts and investigate into it to see whether all the records was fairly recorded. Because remember, the auditor is acting on, it has been appointed by the shareholders to check on the management to see whether the assertion that the management have made, they are right or they are not. And then he will express his opinion on it. So his duty, the auditor needs to understand also the risks of these related parties transactions control. Sometimes the organization may have put internal controls there to help them record some of the transactions of the related parties. So the auditor need to go through to verify if the internal controls are adequate enough. They are what? Adequate enough. That is what the auditor must do. Now, when the auditor is doing that, the auditor also one or the other to try as much as possible also to review some of the investments made by the management, because sometimes the management may be closer to some organizations because maybe they have some personal relationship with them. What they normally do is that they want to invest the business money into that organization. So the auditor must investigate into those transactions and see whether indeed the records of this investment was well done or it wasn't. Or if there is any fraud, he now discuss those ones with those charged with what? Governance. That is what happened. Now, if the auditor visits the organization and he wants to, in the process, what he normally do is that he will start by what we call, we have some procedures. I just want to show you that those procedures, and then we continue. So the procedures, he'll first confirm the terms of the transaction, confirm terms of all transactions with related parties. That's the first thing that he will do. He has to confirm all the transactions that has taken place. And then if he's confirming that, remember, if he's looking at the confirming that, he also confirm the conditions attached to that, and as well as also the amount involved. He will do that. That is what the auditor will do. Now, if he does that, he also inspect evidence of appropriate authorization. You also inspect the evidence of what? Evidence of appropriate authorization. So, who gave the authority for these transactions to be recorded? Or who gave this authority for this transaction to take place? That is what the auditor will do. Another thing also the auditor can also do is that if it is possible, he may confirm and discuss with relevant independent persons. So, for example, if the transaction went to the bank, or maybe there were lawyers involved in the transaction, he can also confirm or discuss or with them. So let me type it right here. Confirm or discuss with relevant independent persons. That is, if the money went to the bank, or maybe there were lawyers involved in the issue, we can also discuss with them and then tell them how the transaction took place and see whether everything is okay. Then as well too, the next thing that he can also do is that he will now review. So these are the process. I'm teaching you the processes so that actually can serve you as a guide in case maybe you meet someone or you approach transactions that you need to verify the issues. So the next one is that they will now review the related parties' financial statements or financial information for related party disclosure made. So what they will do is that they will now review related parties financial statement. So they'll review related parties financial statements, and then as well to they will check it with that of what for how it needs to be done in terms of the disclosure of related parties. So related party disclosure made. So they will try their possible best to review how these related party transactions have been done in terms of the way it is supposed to be done. Because related party transactions, you need to disclose it in a particular way. So they need to follow that procedure. So if they're able to review that, and they now can now do that. But note that in case the transaction was not in the normal course of the business, if the transaction that they did, it was not in the, it was outside the normal business processes, then the auditor must evaluate the rationale behind that type of transaction that took place. It's a related party transaction, yes. Was it outside the normal business transaction? Yes. Okay, let us understand the reason why the organization entered into that particular transaction. If possible, management must explain to us, and this one must make sense. They must explain to us the reason why they entered into that particular transaction. And then request that was a request for any disclosure that was made in the financial statement. So if it is outside the normal course of the business, management, we need to understand the rationale behind it. And what by understanding what it means, we need to ask questions for management. Management must explain to us the reason why they entered into that transaction, and then how they accounted for it, and even who gave the authorization. That is what will happen. That is if it is the normal, if it's outside the normal course of the business. Now, another issue may happen that if we find out a related parties, but management did not tell us, what do you do? Because you are going to do the investigation. You see, during the engagement process, we request for representation from management, where they tell us they are responsible for the preparation of the financial statements. They are responsible for providing us with the relevant information. They are responsible for disclosing all the information in the financial statement. So now, if management fail to provide those related parties, but we find out, what do we do? If we find out what they have done without they informing us, what we have to do is that as auditors, we tell the engagement team that we find out that there was a related party that was not disclosed in the financial statement. Then we also inform management about it, that management, we found out that there was a related party transaction you did not disclose, but we have seen. Then we now ask management why they fail to recognize them. Then if they are able to tell us why they fail to recognize them, then we go ahead to do a substantive audit procedure to identify all the risks that is likely to happen if this information was not well disclosed, and its effect on the audit report.
Then if management fail to disclose the information well, then we now say, okay, based on what we requested for, you didn't inform us. So then they can now tell those charged with governance that you requested us for us to audit this company, but then with this information, we saw there was a related transaction. Management failed to disclose it to. We asked for why they couldn't provide us with a tangible reason. So this is what we have for you. Then you tell them. So that is what the auditor does. So most often, if the auditor is not able to get enough information from this related transaction, then you can give a disclaimer. You can give a disclaimer, especially if he thinks that the information or the evidence that he needed was uh, was was something that was relevant and that it's affecting the whole financial statement. So then it is pervasive. Because it is pervasive, we will give a disclaimer. But if he thinks that that transaction alone is not pervasive, then he will give a qualified opinion. Then you say, except for this transaction, the financial statement, it is true and fair. That is how related party transactions are dealt with. That is how related party transactions are dealt with. Okay. Any question from this related party transactions? Okay. Now, there are other assignments that the auditors can do. Apart from auditing the organization, they can also engage themselves in other assignments. So sometimes I told you that the auditor can be called upon to perform a statutory audit or non-statutory audit. Statutory audit means is required by the law. Non-statutory audit is that just come and then just give us an opinion on a particular engagement, then they just call on you. But again, sometimes the auditor can be called upon to do a forensic audit. Please, have you heard of a forensic audit before?
Yes, sir.
Yeah, so what you heard it? Where did you hear it?
When the aircraft incident occurred.
When the aircraft incident occurred. Hmm. So when the aircraft incident occurred, they said that we should do a forensic audit to investigate that. Apart from that, there was another forensic audit that was said in this country that the government said they should do a forensic audit.
Cathedral.
Cathedral, thank you. So it means that everyone is aware that at least there's another engagement that the auditor can do. That is what we call a forensic audit. Now, forensic audit is forensic audit can find itself in a lot of terms. Some people say, because we are accountants, so we can say we have forensic accounting, we have forensic investigation, then we also have forensic audit. Now, before I explain the forensic audit, the forensic accounting is just trying to apply your accounting knowledge and skills. So it involves in the application of your accounting knowledge and skills. That is your forensic accounting. But when you talk about the forensic investigation is you trying to gather evidence of what has happened. So before we can do forensic audit, forensic accounting may have taken place by the application of the accounting knowledge and skills. Then the forensic investigation also will come in, because another time you use the forensic for. That's you trying to get it. So it's a process of gathering evidence. Then When we come to the rare forensic audits that the auditors do, it is just the application of the audit procedures that they already know in a forensic investigation. So the forensic audit is just the application of the audit procedures or the techniques or the way of doing the traditional audit in the forensic investigation. Because forensic investigation is about gathering of evidence. So if they are going to do a forensic audit, that means they are going to gather an evidence so that they can use that in finalizing the decision. So when there are legal issues, when there are financial matters, and then we think there are criminal matters or there are civil disputes, then or we suspect some fraud, or we think if like the insurance people, if they think that the car you came to insure, one or the other, you were the actual cause of you were the one who caused the accident. They need to do a forensic audit to understand the issues before they can give you your claim. Or maybe if there was a negligence on your part, but you failed to tell us the story, then they have to come in and then investigate and gather evidence and say that, okay, this issue is about your own negligence, so we are not going to give you this claim, or we are not going to restore you to your position that you previously enjoyed. So in that case, the forensic audit comes in. So if we suspect some fraud, if there's an insurance claim and then they want to determine the actual amount you're supposed to get, and they are thinking that maybe it is because of some negligence on your part, or it's because maybe one or the other criminals are trying to hide the proceeds of or the proceeds from their activities that they have engaged in. We do forensic audit to do that, so that we know that, okay, this thing was as a result of this issue. So even if people get divorced, sometimes we do forensic audit to know, okay, what are some of the assets that were available to the spouse? Which of them did they owe together? Which of them that came in? Which of them was there before the marriage started or before they entered into the marriage? Which of the assets were in existence? And which of them came after the marriage? So they will look at all this. So they want to do investigation, trying to gather that information before they can give their opinion. So forensic audit, it is about the forensic accountant trying to gather an evidence to make a case. And most often, this case, they make it at a court. That is what happened. They make it at a court. So if an accountant has prepared a financial statement and they think there's an issue, then what it means that they need to do forensic. So you realize that a cathedral, after the external auditors has audited a company, then the president, through the spokesperson, said that the president has asked that there should be a forensic audit. So they should gather enough evidence to make the case. Work. So that is what happened. So now, if they are going to do this forensic audit, they need to plan. They need to understand the nature of the investigation they are going to deal with. Is it about money laundering? Is it about fraud? Is it about loss estimation? The auditors or the forensic auditor must try his possible best to understand the nature of that particular investigation that they are going into. Then what it means is that after understanding the nature of this investigation, you need to know the type of report that will be needed during this investigation. So trying to know, okay, which people actually entered into the contract, which people actually were who gave the opinion, the first place, who gave the first opinion. Okay, maybe KPMG gave the first opinion. Okay, what type of opinion did they give? Maybe they gave a disclaimer opinion. Okay, it means that they were trying to look for a sufficient evidence. They didn't get it. So as we are going there, we are going to look for that sufficient evidence that we needed and that the auditors needed that they didn't get. We are going to search for it. If we're not able to search for it, we are not able to obtain that, then we can now give our opinion to what has happened. So that's what the auditor does. So during the meeting, they understand the nature of the investigation. They understand they get to know the type of report that they will need. Then as well too, and as part of the planning stage, they get to know what work has been done already. So was the police involved in that? So maybe there is money laundering. You are going to do forensic audit. Was the police aware of the situation? What report did the police write? Was Yoko part of the investigation? What was their report? Was it an immigration issue? What was those reports coming from there? So this forensic audit, they pick the works from other people. What work has been done already? They pick the work from other people so they can use that information to guide them in gathering the actual evidence that they make. Because when you gather the evidence, you need to make a strong case at the law court. That is what will happen. Now, during the investigation process, they need to test certain items to know the areas that they suspect that this issue may have occurred. That is how the forensic audit goes. So they'll look for the areas that they think that these areas there is likelihood that the fraud activity actually took place here. So let us investigate into it. So again, if maybe there's an insurance claim, he said that you're having a shop, then the shop, you came to report to the insurance company that your whole shop, you were attacked, and when you were attacked, all the items in the shop has been stolen at gunpoint. So now you are coming for an insurance claim. Then the insurance people need to be convinced about your situation before they can insure you, or before they can give you your claim that you have. So now, was there any CCTV footage? Yes, there was CCTV footage. But if they think that the claim you are coming for, maybe it was a conspiracy, maybe you conspire with someone to come and then take your things, and later on you come for your claim, they will investigate onto all those things. So if they're able to arrive at the conclusion, then they can say, okay, per our forensic audit, we realize that everything is okay, so then take your claim. That's what happened. So during the investigation, they go into it. If they suspect maybe there was bribery for payment for some contracts, During the investigation stage, they'll employ all the possible ways they'll be able to detect the suspects whom they think that they were involved in maybe bribing the others to get the contract. Because some people, some organizations, before they can get some contract, they need to go and bribe something. So when you're doing investigation, we need to investigate to get all the guru boys who were involved in this process. That's how the forensic audit takes place. So forensic audit is quite different from the normal financial statement audit. How is it different? With the forensic audit, you need a special skill. You should be like a specialist. You should be someone who can question witnesses or suspects. Though you are not a policeman, though you are not a CID, but you should be like a specialist who can question the suspects. But with the financial statement audit is just the normal audit skills you must have. All of them must be accountants, but one of them is a specialist. That's what is the difference between the two. So with the forensic auditor, the person is a specialist. By the normal auditor, he's just having the normal skills of being an auditor. Now, when we are going to audit the normal financial statement, we plan for it, and it's on regular basis. But with the forensic audit, it's not something that is planned. It just comes unexpected, and it is so urgent that you need to take. It needs to be done. So, in terms of its predictability, you can't predict forensic audit, but then with the financial statement audits, you can easily go for boys on regular basis, and it's always planned. Because remember that with a normal regular audit, the auditor needs to get his engagement team plan how the audit needs to be done. But with the forensic audit, you just need a specialized person who will gather enough staff to go with and then do the investigation. Remember, it's not something that is expected, but it is urgent. They need to do it. Now, with the foreign financial statement audit, that one they can use maybe they can use computers to help them select the samples that they want to test. Because remember, I taught you sampling, samples and sampling, and they also test the controls. So with the financial statement audit, there is testing of controls, there is selection, or there is a sampling selection. But with forensic audit, we just examine the whole thing 100%. So forensic audit, they don't say they are just going to do this portion and just leave it like that. No, they're going to do everything. So 100% transactions. So that is what they do. They examine everything. But with normal financial statement audit, it's just samples. That's the difference between the financial statement audit and then the forensic audit. But with the financial statement audit, most often it is based on the engagement. What the engagement letter is saying is what they will do. But with this forensic audit, there's nothing like you trying to agree to the engagement letter. No, it is by law, because there are legal rules in collect, because you need to have an evidence to show. And sometimes they can even go for a court order to compel you to produce that evidence. So in terms of forensic audit, because it is something that is backing by law, the auditor who comes needs to obtain, sometimes if there's a need for him to obtain to obtain a court order for that evidence. You obtain it. But with normal financial statement audit, there's nothing like a court order for it, because you don't need to testify at a law court. Now, with the financial statement audit, we can interview anyone in the financial statement, in the organization, in terms of the financial statement that has been prepared. So any client of the organization, if you are doing the normal financial statement audit, we can interview anyone, ask how the transaction took place, but with the forensic audit, we only concentrate on the suspects. That's the reason why we said we need a specialist who should have what? A questioning mind. Who should be able to question the people. Like if you suspect any fraudulent activity taking place. That's what happened. So this is what happened if the organization goes in for this particular duty, that is forensic audit. Any question here under forensic audit?
Yes, meaning always forensic audit occurs whenever there is a suspicion of whether fraud activity or things are not going well in such an entity.
Yeah, so if there is fraudulent activity, as well as to if they suspect that there is a mistake or there's money laundering, they can also investigate into the situation. Or if they think that the loss that has occurred is too much, so we need to investigate into that loss, there can be forensic audit.
Okay, thank you.
Okay.
Sir.
Yes, please.
Yes, sir. So at the end of the day, you have done first investigation. Auditors have done their work. They have been paid. Then you say that you are not satisfied. So a forensic audit should be carried out. And that is also done. And then we pay them. And at the end of the day, the forensic audit says that, yes, there is nothing suspicious about such entities. Are you not also causing financial loss to us?
No, you didn't. You're not causing any financial loss. You wanted to confirm the issues because you suspected that there are fraudulent activities or the loss is too much. So we need to investigate into it. So now the forensic audit, you are rather paying attention to the suspected areas. It was not the whole. So this one, the suspected areas, as well as to you're auditing everything. Remember, when the auditors went there, they just sample. They didn't do everything. Auditors don't do everything. If not, you can't pay them. And in no time, we will talk about audit fees. We will look at audit fees too in no time. So you can't pay them. So what you have to do is that when you call them, you inform them, and then you now tell them that they, I want you to audit the financial statement for me. So if they're auditing the financial statement, they will now decide that, okay, we will sample this aspect and deal with it. But if you ask them to audit the whole organization, then it means that it will be a whole cost to you. So fine, you now after engaging them to audit the financial statement, they wrote their report, you pay them off. Now, when the report came, you still think that no, you are not convinced. So you then ask them to do it. Yes, indeed, because you wanted to, you want to like to be sure of yourself, because auditors are independent people. Auditors are independent, and you expect that they will give you an independent opinion. Yes, that's what you think they can do for you as an owner of the business or maybe a shareholder of the business. So you think they will give you what an opinion that is independent. There are no compromise. Yes, the forensic auditors also came in. They also did their job. They did the whole transaction, all the transactions were involved. They audited everything. Those that they think were suspects, they investigated into it, they questioned them, and they realized that everything is okay. Then there is no loss to the state. So now you now come and then say that, yes, the auditors went there, we did a forensic audit, and we realized that everything is okay. It's only some part of the country that people think that the government may have wasted money for doing maybe a forensic audit, or maybe a business. Some individuals may have wasted money for doing forensic audits. No, you've not wasted. It's just that you wanted to confirm the issues because people were raising more issue that there's an issue. Please investigate. And you did by investigating. So you now come and tell us the story that after the investigation, we realize that everything is okay. So if it is okay, then we all get our free mind. Because now two audits have been done, the main audit and then forensic audit. So now you can't go and stand anywhere and say that someone has spent the money when you have no claim, because that one, the person can take you to court. The person can take you to court for engaging in that. So that is what happened. So it's not a loss to the state. Senior, please, are you okay?
Yes, sir.
Right. So now, let's look at another aspect, that is advertising, fees, and tendering for work. So it's another aspect that we need to note. Now, auditors are not there to advertise themselves. It's not good. They shouldn't do that. They shouldn't be saying that, oh, for me, come to me. My fees are low. Come to me. If you come to me, I will do the work fast for you. I'm good. I'm better than this company. You give an information that is misleading for people to come to you. We don't do that. In Ghana here, we have the four big firms: Audit, Deloitte, SNY, Price Waters, KPMG. Then as what we also have private audit companies, which are registered under ICAG, Chartered, that's Institute of Chartered Accountants Ghana, has also given accreditation to some individuals, private individuals, to have audit firms. So even if you have your business and you're a sole proprietor, you have your own business, and you think you need people to audit your company, you can go for this private company, and they have categories of them: A, B, B1, or C, D. They are all there. Depending on the type of people or the type of audit you need, you can go to them. And then as well too, some people say that if you want to pay low amount of money, you can go for the D and the C. But if you want to pay huge amount of money, you have to go to the A and the B. But they don't advertise themselves. They are just there. But what they do is that if they are there as a company, they are not there to discredit other companies, as I said, saying that, oh, for me, my audit company is good. We have good auditors. Oh, there are people. I once worked with KPMG, and that I was a manager over there, or maybe I was an audit associate, or maybe I was a partner, and I left KPMG to come and do their job here, and I've brought all qualified people to come from first class students, come and then be part of my audit team or my company. We don't do that. We don't do that, those things to discredit other firms. But what they do is that they try their possible best to be clear and accurate about all their transactions that they deal with. So they don't also talk ill about. So if I'm just projecting the slide, what happened is that they don't make any unsubstantiated claims. They make no adverse comments about fellow professionals. They are not to break any local rules of advertising practices. And even they are not there to mention their fees. But then if you visit them for them to tell you their fees, they should give you the basis of the charge. So you said that in my slides, I said that it is preferred that fees are not mentioned in the advertisements. Even if you do an advertisement, you should ensure that you don't do these things. You don't even mention the fees there. They are not. You are not to do adverts, but if you are to do it, then make sure that you don't go against this or you don't have these things in your advert. So that is what happened. So if you need auditors, or if an auditor comes, or the audit firms, they are not there to advertise. But if they do advertise, then they should make sure that they make no unsubstantiated claims. They have no adverse comments about their fellow professionals. They must not break any local code for advertising practices. That's why in the radio stations or television, you never hear saying this audit company is there. Come and let them audit you. You've never heard of it before. They don't go there. They don't do those things. If not, you'll be hearing radio stations trying to do adverts for these audit firms. Okay. Then the next one is the fees that they charge. They also have fees. So now, the fees, if they want to state the fees, then they should give the basis of the fees that they are giving. Now, when they want to give the fees, it should be based on the scope of work. You are asking them to do an audit of your financial statement. Detailed one or not detailed one. Oh, we don't want a detailed one. Then they'll tell you the charge. If you want a detailed one, then it means that they need to plan and come and then look at all the things that all the issues that they suspect that it may bring about fraud, but they are not there to detect fraud. But then all the issues that they are supposed to detect, they will detect them. They will detect them. That is what they do. So they will try their possible best to go, whether if you want detailed one, they will look at it. But most often, low borrowing is allowed, but it's not an ideal one. So low borrowing is where it's like they start a process. Then you tell them that, okay, and so when they start the process, we will charge you this amount. Later on, you add something to it again. Later on, you add on another one. So it's like they will charge the fees based on the low borrowing. Those ones, though it is good, but most of it, you don't allow it. Just tell them the scope of the work, and then they will start the process. When they are done, they leave. That's how the audit fees supposed to come. So most often, when as part of their engagement letter, they will state their audit fees. So you look at this. I said that the fee should reflect the time spent on the audit and the level and experience of staff they are going to use. And then as well, it should reflect the importance of the work to the client, and as well to the overheads and other costs incurred in providing the services. All of them should be there. Then it should not be based on, yes,
Sir,
please.
please, your screen
Yes.
is not showing. Your screen.
No, Then please, it's your network. My screen is showing.
Okay.
Please, that for all of you.
No, sir.
Right, right. Okay. So it should not be based on the percentage or or the contingent calculation, unless it is conventional. It is conventional in the service provided. So it should not be said that based on this, so I'm charging this percentage, or based on what you like contingents, because you are bringing in there's a contingent fees I want to charge. No, it shouldn't be that. We should note that. We should note that. So now, another thing also we must note also is that they can be overdue fees. When they are overdue fees, actually means that you're supposed to pay the auditor and they have not paid the auditor. Overdue fees. And when there's an overdue fee, it can affect the independency of the auditor, especially if the auditor is coming to audit a particular company, and then the company once owed the auditor, they've not paid the auditor. How will the auditor audit with the right freedom of mind? You will not be able to audit with the right freedom of mind. So it will affect its independence. And the threat to independence would be severe if fees owed is material. So if the fees you owe the person, maybe the person first charged 10,000, and now you are giving 10,000, you gave the person 2,000, left with 8,000. That means the next one, it will affect the person. They said, but you, if I come to you, you might not even pay me the amount you are you is due me. You wait till another period when I'm coming before you go and pay another one, which is not good. And sometimes there's difficulty to continue, especially if the auditor is paying attention to the payment. Sometimes it becomes very difficult. And then also the auditor should assess the effect of unpaid fees on the independency and the integrity or his integrity. So what happens is that if there's an overdue fees, the auditor must check whether these fees can affect his independency and as well to his integrity. That is what will happen. Now, sometimes the auditor can be changed. So let us look at this. Professional appointment. Sometimes the client can change the auditor. And one of them is that when there's a disagreement over the audit fees. The auditor says, I want to take 12,000 next period, this time. But last year I took 10,000. But the auditor is saying, I want to take 12,000 this time. So since he's willing to take 12,000 this time, then it means that you don't have the money, so you have to change the auditor. Or sometimes the audit firm will be too small. Your company is growing. Say the company is growing, the audit firm becomes too small. Because of that, the business decides to change the auditors. So UCC is so big. We can't say maybe category D or category C should come and audit the UCC. No, they'll either go in for KPMG or they'll go in, Ghana audits themselves will come and then audit UCC. So that at least, though, if Ghana audit comes to audit UCC, they can tax any of the big firms to come and then audit, and then they will pay them. Because sometimes we have what we call joint audit. So joint audits can happen where a company or Ghana Audit Services together with KPMG comes to audit maybe UCC.
is a joint audit, because we think that this aspect, there's a specialized area and we don't have the expertise. So we are inviting people from KPMG to come and then help us in auditing. So you see, Ghana is big. The audit service, Ghana Audit Services, the staff, they are not so many. So when they are going to do the audit, they also involve other audit companies, and then they'll go and then do the audit. But at the end, when they meet at public accounts committee, they will say the auditor's report. But it is possible that it is not, it is true that it's not the main, it was not the auditor general who went there, but rather asked other audit company to do it on his behalf. But because it was a joint audit, they will just say, yes, we asked them to do it for us, but it is our work. So they will just, because they pay those people off. So that is what they do. So when the firm is so small, when the audit firm is so small, sometimes they can change the audit. Then also to when there's personality conflict, this one is self-explanatory. When there's independence reasons, we can change the auditor. When there's conflict of interest, the auditor can also be changed. And when the audit firm chooses not to seek re-election, so when the auditor says that this time I won't continue again, we can also change the auditor. So these are the reasons why auditors can be changed, and note them very carefully so that we can apply them. Now, another thing also I would like to talk about is the client due diligence. So before accepting a client, an audit firm should consider the following. So before the auditor is accepting the client, he also must do client due diligence. What he must do is that he must ask himself, does the firm have time to do the audit and meet the client's deadlines? So before we are going to do the audit, does the firm, do we have the time to do the audit? And can we meet the timelines for the client? Because the audit firm is the one going there. So the audit firm must do client due diligence. So the auditor is the one who asks, or the audit firm is the one asking, do we have the time to do the audit? Or our hands are tied, so maybe we have to inform the client that this time we can't do it. Then the next one is that, does the firm have the staff and resources? The auditor will be asking this question. I'm going to audit this company, my company. Do we have enough resources and staff to undertake this activity? Then the next one is that professional clearance issue raised by outgoing auditor. So we will have to pay our attention to the professional clearance that has been issued by the one who was going. So that's why I told you that before we accept the engagement, we should tell the client that we have to also to speak to the outgoing. This came up last time when we were having a discussion, that we need to speak to the outgoing auditors and ask for their report, and then even ask the reason why they left, so that it will guide us in our decisions that we'll be making. And then we also, in the due diligence, we ensure that outgoing firm was correctly removed or was resigned. And then as well too, we also should assess the integrity of the client and its directors, and also assess the risk of the client. So all this is just telling us that before you can go in to audit the company, you need to do client due diligence. You need to also to do your own due diligence to understand the issues before you go in for that particular audit. So that is what we are doing today. Today we've talked about a lot of things. All right. So with a few minutes left for us to end, I want to ask you the things you were able to jot down for us to end the class. So what have you learned today? You see, for my last week, last Friday, I asked you. I know why I'm asking you that. So you need to pay attention to the issues we are discussing, getting to the later part of the discussion. So please, what have you learned today? If it's not learning anything, then we can learn the end the class. So please, what have you learned today?
So let me ask a question before.
Stand it and ask a question.
Okay. So I just want to clear this thing that the client due diligence, it is the auditor who is accepting to work for a particular entity that is doing these processes we have here.
Yes.
Okay. Thank you.
Okay. Yeah, so the question, please. Please answer my question. What have you learned today?
Today we went over about the opinions that we thought about last week. So we went over to explain details about them. Today to you took us through the related parties. And you asked us about the related parties. Said that the related parties are the close association of the company, those that when the auditor comes to audit, those the company who are related to the company, the other parties who are related to the company that the auditors are coming to audit, they will look at all of those things and they confirm the terms of all the transactions with the related parties. They inspect the evidence of appropriate authorization. They also confirm with relevant independent persons like the banks, the lawyers, and others. Any related relevant independent person that they can get information from. And they also review related parties' financial statements. They also review it. So somebody should also continue.
Thank you. You said another person should continue.
Yeah, we also had a look at forensic audit and financial statement audit. And forensic audit entails or is whenever there's a suspicion of whether misappropriation of fund or fraud detection. But for the financial statement audit, it's a normal order to find or look at the entity financial position or financial statements.
Okay, please. Thank you. Okay, so
But to ask you the forensic audit, you made us aware that with the forensic type, the normal auditing. So when a power plays every relevant period to help take to the whole for.
Mr. Erasmus, we hardly hear you.
Oh, sorry. Can you hear me?
Yes.
So as I was saying, with the forensic audit, it has to do with a detailed assessment of material facts to ascertain whether or not there is a misstatement or fraud elsewhere as compared to the normal auditing. That's what I want to add to what my brother just said.
Okay, thank you. Okay, so far so good. We will end here. I'm just hoping that God will Friday we can maybe extend the time to 3 hours where we will solve questions. I'll show you questions, then we'll all look at it and see how we can answer them. I hope next weekend is just a revision week, right?
Yes, sir.
Yes,
Yes, sir.
sir.
Yes, sir.
Yeah, so at least we can use the Friday evening to go through some of the issues. So at least as we prepare ourselves for the end of semester, the quiz, and then the end of semester as well. So please try your possible best to understand the issues. Now, most of the things I was saying, they are all in the slides. They are all there. Just look at them very well. Uh-huh. If there are other things too, I will discuss with Prof to ask if maybe we should give all of you some set of questions, which may be like maybe 20 or 50. Then it can serve as a guide for you to know how auditing questions are. I will ask him if he agrees. Then we will share with you those questions for you to go through them in a way as a guide to know how auditing questions are. Auditing questions, they are not on the floor. Uh-huh. They are not on the floor. You need to pay attention to the issues and then you need to write and discuss the issues very well. Is that a normal? It's not a normal calculation thing that we know. No, it's about you trying to uh, discuss the thing and then tell us the risk. Telling us testing the controls, identifying the audit risks, testing the internal controls, testing whether all the controls are adequate, and even the procedures for you to go through to test them. We need to look at all those ones. So God willing, Friday we will look at them and then we can say that God has been good to us. Right. Any other question from anyone?
Okay, thank you. Really appreciate your effort.
You are I also appreciate your time too.
Thank
So
you.
on that
So,
note, yes, please.
so before
Mhm.
you draw the curtain, uh, if I understand,
Mr. Erasmus,
yes, sir.
yes,
Sir,
you
can
are
you hear
talking.
me?
Yes, we can hear
Can
you.
uh-huh. So, looking at what you were trying to insinuate, it means that, or it presupposes that most of the auditing question is going to be in the form of a case study
Correct,
for us. Wow.
correct.
Okay.
Mm,
Uh,
Nowadays, the what is, uh, it's not the best, but we will see. But then just to get to know that auditing questions they are more of case. But if there is what is, at least you get to know. Let's see how God and Friday will be, and let's see the set of questions that will be answered. But note that it is covering everything. So for sure, we've done everything on the course outline. So just left with some few touches, and then we are done. So please note that the things they are a lot. Even the slides itself, there are many. But you try possible best to see how you can go through, and then as well to. But did you get any manual, any book that you are using? Did you
No,
receive
sir.
any the code? We don't have the code book.
No,
no.
sir. We only
Oh,
depend on the slides.
Relying on
on the
you.
slides.
Yes.
Yes.
So I wanted to even tell you that the previous ones, the previous note that you took for us, if you can resend it to us. But that
The
one is
notes,
like exercise.
the notes are in your, the same notes are there. So the same notes, there are things in the slides. It's just that I was not reading the slides, so I was just typing them for you to see. But they are there.
That one, they are there, but it's like your own has been arranged according to the topic that you were teaching. That's right.
Oh, okay, I understand you. Anyway, please, your group. Let me see. Okay, the recording still. Okay. Okay, so I have seen is Mr. Hammond in your group?
Yes, sir.
That's Andrew.
Mr.
Andrew.
Hammond,
Yeah.
Evangelist Hammond. Then okay,
Hmm.
so I've seen that group.
The only evangelist. Hmm.
Okay, so
Surely.
I'm placing the document over there so that at least
Okay.
you can have access to it. There are questions
Okay.
at the
Thank
back. There are questions at the back too. So you can
you. Okay.
look at it and see how this is the normal book that they have been using. So there are questions and answers at the back. See how the audit questions are being answered. At least it will serve you as a guide. Though there are plenty, but try your possible best to look at it.
Okay.
All
Thank you,
right.
sir. Thank you very
Right.
much.
Thank you.
Thank you.
Okay. So have a good evening.
Thank you, sir. Thank you.
We are grateful, sir.
I'm also grateful for your time. Bye.
Bye.
Bye.